Before we begin, please remember that I am not a licensed insurance agent or a financial advisor. The information provided in this video is for educational and informational purposes only and does not constitute financial or legal advice. Your insurance needs are unique to your personal situation. You should always consult with a qualified and licensed professional before making any decisions about your insurance coverage. Imagine this for a second. You're driving home from work, maybe listening to a podcast, thinking about what's for dinner. Traffic is a little heavy, but it's moving. Suddenly, the car in front of you slams on its brakes. You react instantly, but it's too late. The crunch of metal is sickening. It's a classic fender bender. No one's hurt, thank God, but the other car, a brand new luxury sedan, has a crumpled bumper and a shattered taillight. You do everything right. You exchange information, you take pictures, you call your insurance company. You're not worried. Why would you be? You have full coverage. You've been paying for it for years. Then a week later you get the call. It's your insurance adjuster. He sounds apologetic. He tells you that the damage to the other car is estimated at $22,000. And your policy only covers $10,000 for property damage. You're on the hook for the other $12,000. Out of your own pocket. Right now, your stomach drops. How is this possible? You have full coverage. But the adjuster explains patiently that full coverage isn't a real insurance term. It's a marketing phrase. And the state minimum coverage you signed up for years ago to get the lowest price is now about to cost you more than a year's worth of rent. This isn't a scare tactic. This exact scenario plays out thousands of times a day across America. A recent survey found that over 40% of drivers who believe they have full coverage are actually carrying dangerously low limits that could leave them financially ruined after a single, common accident. They're paying every single month for a false sense of security. The problem is that your insurance policy is a legal contract written by lawyers for lawyers. It's intentionally confusing. It's filled with jargon and loopholes designed to protect the insurance company, not you. But that ends today. In the next 10 minutes, I am going to pull back the curtain. I'm going to translate your entire auto insurance policy from confusing legalese into plain, simple English. You will learn exactly what you are paying for, what you're not covered for, and how to spot the critical gaps that could bankrupt you. By the end of this video, you will understand your coverage better than 95% of drivers on the road, and you'll have the confidence to know you are truly protected. So let's get started. The first thing you need to understand is that your entire insurance policy, which can be a 50-page document of dense text, can be completely understood by looking at one single page. This is the Holy Grail. It's called the Declarations page. You might hear it called the Deck page. This is your cheat sheet. It's the table of contents for your protection. When you get your policy in the mail or online, this is the first page. It summarizes everything. If you learn to read just this one page, you've won half the battle. Go ahead, pause this video and pull yours up right now if you can. It's on your insurer's website or app. Oh wait, okay, you got it? Look at the top. You'll see your policy number, the effective dates of the policy, usually a 6 or 12-month term, and your name and address. This section lists the named insured, which is you and anyone else in your household covered by the policy like a spouse. Below that, you'll see your vehicles listed with their VIN numbers. Make sure this is all correct. A simple typo here can cause massive headaches later. But now we get to the most important part of the page. It's a box or a list, usually in the middle, labeled coverages, limits, and premiums. This is the heart of your policy. This is where you see exactly what you're paying for and how much protection you actually have. We're going to go through these line by line, starting with the single most important coverage you have. It's not the coverage for your car. It's the coverage for the other guy's car. It's called liability coverage. Liability is a legal term for responsibility. This is the coverage that pays for the damage you cause to other people and their property if an accident is your fault. This is the part of your insurance that is legally required in nearly every state. It is the one thing you absolutely cannot drive without. And it's the one that can destroy you financially if you get it wrong. On your deck page, you'll see it broken down, usually into two lines: bodily injury liability and property damage liability. Let's look at bodily injury first. You'll see two numbers separated by a slash. It might say something like 25/50th, or 50/100, or 250/500. These numbers are in thousands of dollars. So 2550 means you have $25,000 of coverage for a single person's injuries in an accident you cause. and a maximum of $50,000 for all injuries in that single accident, no matter how many people are hurt. Let's break that down. The first number is the per-person limit. Say you run a red light and hit a car and the other driver breaks their leg. Their medical bills from the ambulance ride, the emergency room, the surgery, and the physical therapy come to $40,000. If your per-person limit is only $25,000, which is the state minimum in many places, your insurance company will write a check for $25,000 and then wish you the best of luck. The other driver's insurance company or their lawyer will then come after you personally for the remaining $15,000. They can garnish your wages, put a lien on your house, and drain your savings account. All because of that one number. The second number is the per-accident limit. Let's use that same 25/50ths example. Say in that same accident, the driver had a passenger. The driver's bills are $30,000, and the passengers are $30,000. That's $60,000 in total medical bills. Your policy has a $50,000 maximum payout for the entire accident. So even though you technically have enough to cover one person, you don't have enough to cover both. Your insurance pays out its max of $50,000, and you are now personally on the hook for the remaining $10,000. You can see how quickly these state minimum limits become completely useless in the real world, where a single night in a hospital can cost more than 25 grand. Now for the second part of liability coverage, property damage. On your deck page, this will be the third number in that sequence. You might see 25/50/25. That last number, 25, means you have $25,000 of coverage for any property you damage in an at-fault accident. This is primarily for the other person's car, but it also covers anything else you might hit: a mailbox, a street sign, a storefront, a guardrail. This is the number that was the problem in the story I told you at the beginning. The driver had a state minimum limit, maybe $10,000 or $15,000, but the damage to the new luxury car was over $20,000. The average price of a new car in the United States today is nearly $50,000. Think about how many Teslas, new pickup trucks, and luxury SUVs you see on your daily commute. If you cause a multi-car pileup, or you total someone's brand new Ford F-150, how far do you think a $25,000 limit is going to go? Not far enough. Their insurance company will pay to fix their client's car, and then their lawyers will send you a very official, very scary letter demanding you pay them back for every single dollar your policy didn't cover. So, the single most important action item for you after watching this video is to look at those 3 liability numbers on your declarations page. If you see low numbers like 25/50/25, or anything close to it, you are driving with a financial time bomb. You are one slippery road or one moment of distraction away from a lifetime of debt. Raising these limits is shockingly inexpensive. We're often talking about just a few extra dollars a month to increase your protection from $50,000 to $300,000. It is the single best investment you can make. Now, all of that was about protecting you from having to pay for the other person's injuries in their car. But what about you? What about your car? If you wreck your car, and it's your fault, liability coverage pays you exactly zero. Nothing. That's where the two most famous and most misunderstood types of coverage come in: collision and comprehensive. And the truth about what they really cover, and when you do and don't need them, is not what you think. Let's break them down with a scenario. Imagine you're leaving a crowded parking garage after a long day. You're tired, you're trying to squeeze out of a tight spot, you turn the wheel a little too soon, and then you hear it. That gut-wrenching sound of metal scraping against concrete. You get out, and sure enough, you've left a long, ugly gash down the side of your car from a concrete pillar. You look around. There's no one else involved. It was just you and the pillar. You are 100% at fault. Your liability coverage? Useless here. It only pays for damage you do to other people's stuff. It won't give you a single dime to fix that gash on your car. This is the exact moment collision coverage becomes your hero. Collision is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That could be another car, that concrete pillar, a mailbox, a guardrail, or even if you accidentally flip your car. The key takeaway is that it typically covers you when you are the one at fault for the accident. It's the "I messed up" coverage for your own vehicle. Now let's change the scenario. You park that same car on the street overnight. You wake up the next morning, and a massive tree branch, weakened by a storm, has crashed down and shattered your windshield and crushed your roof. Was that a collision? Not really. You didn't hit anything. Or what if you're driving down a country road at dusk and a deer decides to play chicken? resulting in a very bad day for both of you and your car's front end. Or a freak hailstorm turns your hood into a dimpled mess. Or worst of all, you walk out of the grocery store to find an empty space where your car used to be. It's been stolen. None of these are traditional collisions. This is where the second hero, comprehensive coverage, steps in. Think of comprehensive as other than collision coverage. It's the catch-all for all the weird, unpredictable stuff that can damage your car. It covers theft, vandalism, fire, floods, hail, falling objects, and hitting an animal. The easiest way to remember the difference is this. Collision is when your car hits something. Comprehensive is when something happens to your car. So now you have these two powerful shields protecting the value of your vehicle. But they both come with a catch. A very important catch that costs people thousands of dollars because they don't understand it. That catch is called the deductible. The deductible is the amount of money you have to pay out of your own pocket for a claim before the insurance company starts paying. Think of it as your copay for a car repair. It's your skin in the game. You and the insurance company are sharing the risk. You choose your deductible amount when you buy your policy. Common amounts are $250, $500, or $1,000. And here's the critical trade-off. A higher deductible means you're taking on more risk yourself, so the insurance company rewards you with a lower monthly premium. A lower deductible means the insurance company is on the hook for more money, so they charge you a higher monthly premium. Let's put it into practice. Say you have a $500 deductible for your collision coverage. You have that unfortunate meeting with the parking garage pillar, and the body shop quotes you $4,000 for the repair. You file a claim. You pay the first $500 directly to the body shop. Your insurance company then pays the remaining $3,500. Simple enough. But what if the damage was minor? What if the estimate to fix that scrape is only $450? Since the cost of the repair is less than your $500 deductible, your insurance company pays exactly nothing. You are responsible for the entire bill. In this case, it would be pointless to even file a claim, because it won't result in a payout and could still be marked on your record, potentially raising your rates later. This is a huge point. Your insurance isn't for every little scratch and ding. It's for damage that significantly exceeds your deductible. And here's a pro tip. Collision and comprehensive coverages usually have separate deductibles. You can mix and match them. For example, you might choose a higher deductible, say $1,000 for collision, because claims are often expensive and more likely to be your fault. But you might choose a lower deductible like $250 for comprehensive, because things like a cracked windshield from a rock on the highway are common, relatively cheap to fix, and completely out of your control. This all leads to the million-dollar question. Do you actually need collision and comprehensive? Unlike liability insurance, which is required by law in nearly every state, these two are almost always optional. But optional doesn't mean you have a choice. If you have a loan on your car or you're leasing it, the answer is a hard yes. Your lender or leasing company will absolutely require you to carry both. Why? Because until you pay it off, it's technically their car. It's their asset, and they need to protect their investment from you crashing it or it getting stolen. If you drop the coverage, they have the right to buy a policy for you called force-placed insurance, and it will be astronomically expensive, and they'll just add the cost to your loan payment. The real choice comes when you own your car outright. No loan, no lease, the title is in your name. Now, it's a personal finance decision. The big question you have to ask yourself is this. If my car was destroyed in an accident tomorrow, could I afford to repair it or buy another one without going into serious financial distress? If the answer is no, you need the coverage. But if you're driving an older car, the math gets interesting. This brings us to a guideline some people call the 10% rule. Here's how it works. Find out the actual cash value of your car. You can use a site like Kelley Blue Book, or just see what similar cars are selling for in your area. Then, look at your insurance policy and see how much you're paying per year specifically for collision and comprehensive coverage. If that annual premium is more than 10% of your car's value, it might be time to consider dropping them. Let's say you're driving a 12-year-old sedan. It runs fine, but it's only worth about $3,000. You're paying $400 a year for collision and comp. Well, $400 is more than 10% of $3,000. You're paying a significant amount for a maximum potential payout of just $3,000, and that's before you subtract your deductible. In this scenario, you might be better off dropping the coverage and putting that $400 a year into a dedicated savings account. You are essentially self-insuring. After a few years, you'll have saved enough to cover a major repair or make a down payment on a new car. On the other hand, if your car is worth $20,000 and your coverage costs $600 a year, that's only 3% of its value. Dropping that coverage would be an incredibly risky gamble to save a relatively small amount of money. But there's one final crucial trap you need to know about. It's a term I just used, actual cash value, or ACV. This is the source of more arguments with insurance companies than anything else. When your car is damaged, your insurance company doesn't pay you what you paid for the car. They don't pay you what a brand new one costs. They pay you what your specific car, with its age, its mileage, its dings and scratches, its worn-out tires, was worth 1 second before the accident occurred. It's the fair market value, the Craigslist price, not the shiny dealership price. And it is almost always less than you think it is. So if your car is totaled, the adjuster might say its ACV is $10,000. If you have a $1,000 deductible, the check you get is for $9,000. That's it. That's the money you have to go out and find a replacement car with. And it often comes as a shock to people who thought they were fully covered. So we've now protected other people with liability, and we've protected our own car with collision and comprehensive. But we've ignored the most valuable thing in the entire equation, the people inside the car. Your body. What happens when you get hurt in an accident? Who pays for the ambulance, the hospital bills, the lost wages from not being able to work? The answer to that involves two completely different types of coverage that can make or break your financial future. And depending on your state, one of them might be mandatory. Let's start with the one that might be mandatory. Personal Injury Protection, or PIP. Think of it as your own personal health insurance specifically for car accidents. If you live in one of the dozen or so no-fault states like Florida, Michigan, or New York, you are required by law to carry it. And the concept of no fault is one of the most misunderstood ideas in all of insurance. It does not mean nobody is at fault for an accident. Of course someone is. What it means is that regardless of who is at fault, you turn to your own insurance company first to pay for your medical bills. Your PIP coverage pays out right away. You don't have to wait for the insurance companies to spend months arguing and investigating to decide who caused the crash. You get hurt, you go to the doctor, and your PIP coverage starts paying the bills up to its limit. This is a game changer. It prevents you from having to pay thousands of dollars out of pocket while waiting for a settlement that might not come for a year or more. It's designed to get you medical care fast and to reduce the number of lawsuits clogging up the court system over smaller injury claims. But here's where PIP becomes a true financial lifesaver. It covers so much more than just doctor and hospital bills. This is the critical part. PIP can also cover a percentage of your lost wages if your injuries prevent you from working. Imagine you break your leg in a crash and can't do your construction job for 2 months. Bodily injury liability from the other driver might eventually pay you back for that, but how do you pay your rent and buy groceries for the next 8 weeks? PIP is your answer. Provides that income stream when you need it most. And it doesn't stop there. PIP can also cover things like physical therapy, rehabilitation, psychiatric treatment, and in the worst-case scenario, funeral expenses. It can even pay for what are called essential services. Let's say you're a stay-at-home parent, and your injuries make it impossible to care for your children. PIP could help pay for childcare. If you can't clean your house or mow your lawn, it could help pay for those services. It's designed to help you maintain your life as normally as possible while you recover. So, who does it cover? It covers you, the policyholder, whether you're driving your car, someone else's car, or even if you're hit by a car as a pedestrian or cyclist. It also covers relatives who live in your household, and any passengers in your vehicle at the time of the accident who don't have their own PIP coverage. It is incredibly broad protection for people. The second type of coverage is called medical payments coverage, or MedPay. It sounds very similar to PIP, and it is, but with a few crucial differences. Like PIP, MedPay covers medical expenses for you and your passengers regardless of who is at fault in an accident. If you get rear-ended and need to go to the emergency room for a whiplash evaluation, you can use your MedPay to cover the bill immediately. It's typically optional, and it's most common in states that are not no-fault states. Here is the single biggest difference you need to remember. MedPay covers only medical and funeral expenses. That's it. It does not cover lost wages. It does not cover essential services like childcare. It is a much simpler, more streamlined coverage focused purely on the immediate medical costs of an accident. So why would you want MedPay, especially if you already have good health insurance? That is the million-dollar question. And the answer reveals a massive gap in many people's financial planning. First, your health insurance has a deductible. For many people, that's thousands of dollars. If you have a $5,000 health insurance deductible, you'd have to pay all of that out of pocket before your health plan pays a dime. But if you have $5,000 of MedPay coverage, it can pay that entire bill for you. You pay nothing. It essentially covers your health insurance deductible. Second, MedPay has no networks. You can go to any doctor or hospital you want. Your health insurance, on the other hand, might have strict HMO or PPO networks, and going out of network can be incredibly expensive. Third, MedPay also covers your passengers. If you're driving your friends to a movie and get into an accident, your MedPay can offer to pay for their medical checkups, which is not only the right thing to do but can also prevent them from needing to sue you or your insurance company later. Think of it this way. PIP is the comprehensive, all-in-one package for no-fault states, covering medical bills, lost income, and more. MedPay is the a la carte option for at-fault states. Focus specifically on paying medical bills quickly and filling the gaps left by your health insurance. So let's put this into a real-world story. Meet two drivers, Sarah from New Jersey, a no-fault state, and Tom from Ohio, an at-fault state. Both are in identical, moderate accidents where the other driver is clearly at fault. Sarah has the mandatory PIP coverage required in New Jersey. The ambulance takes her to the hospital. She has a concussion and a fractured wrist, keeping her out of her office job for a month. Her $10,000 hospital bill is immediately sent to her own auto insurance company, which pays it under her PIP coverage. She doesn't see a bill. More importantly, her PIP policy also pays out 60% of her lost salary for the month she can't work. This allows her to pay her mortgage and bills without draining her savings. She's focused on recovery, not financial stress, all while the insurance companies sort out the fault in the background. Now let's look at Tom in Ohio. He chose to add $5,000 of optional MedPay coverage to his policy for an extra $8 a month. His accident results in a trip to the ER and a couple of follow-up visits with a specialist, totaling $4,000 in bills. Tom has a high-deductible health plan and hasn't met his deductible for the year. Normally, he'd have to pay that $4,000 himself and then hope to get reimbursed by the at-fault driver's insurance months later. But because he has MedPay, his auto insurance pays the $4,000 directly to the hospital. He pays nothing out of pocket. He didn't have to dip into his emergency fund. He didn't have to put it on a credit card. For him, MedPay acted as a perfect, inexpensive shield for his health insurance deductible. Both Sarah's PIP and Tom's MedPay did exactly what they were designed to do: provide immediate financial relief for their injuries, regardless of fault. They are your financial first aid kit in a car crash. They protect you, your family, and your passengers. Ignoring them because you think your health insurance has you covered is one of the most common and costly mistakes a driver can make. You might pay a few extra dollars a month, but you are buying yourself peace of mind and protecting yourself from potentially thousands of dollars in immediate out-of-pocket costs. We've now covered the money that pays for the other guy's car and his injuries, that was liability. And we've just covered the money that pays for your own injuries, that's PIP and MedPay. But what about the single biggest piece of the puzzle for most people? What about the damage to your own car? If someone with no insurance plows into you, or you swerve to miss a dog and hit a pole, or a hailstorm turns your hood into a golf ball, who pays to fix or replace your $1,000 or $50,000 vehicle? That's where the two types of coverage that protect your car itself come into play, and they are not the same thing. Let's start with the one that's easier to remember. It's called collision coverage, and it does exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it could also be a guardrail you swiped on a tight corner, a telephone pole you backed into, or even the curb you hit a little too hard, messing up your alignment and cracking a rim. It also covers damage from your car flipping over in an accident. Essentially, if your car is moving and it hits something or it gets hit by something, and the damage is to your own vehicle, collision coverage is what you'll be calling on. Think of it this way. Collision is about the physical impact of your car meeting another object. It's the crunch of metal, the shatter of glass from an impact. And here's the key part that trips people up. It pays out regardless of who is at fault. If you cause the accident by running a red light, your collision coverage will pay to fix your car, minus your deductible. If someone else hits you and they don't have insurance or they don't have enough insurance, you can also use your own collision coverage to get your car fixed quickly, and then let your insurance company go after the other driver's company for the money. It's your direct line to getting your car back on the road after a crash. Now what about that hailstorm we mentioned? Or the deer that jumps out of the woods at dusk? Or the shopping cart that the wind blows directly into your door in the Target parking lot. None of those are a collision in the traditional sense. You didn't hit another car or a pole. This is where the second type of coverage comes in, and its name is a little less straightforward. It's called comprehensive coverage. This is a bit of a misnomer because comprehensive makes it sound like it covers everything. Doesn't. A better name, and one that some insurance companies actually use, is other than collision coverage. That's the perfect way to think about it. If your car is damaged by almost anything other than a collision, comprehensive is what you need. This is your protection against the random, unpredictable chaos of the world. Let's run through the list because it's a big one. Comprehensive covers theft. If someone steals your car, this is the coverage that pays you its value. Vandalism. Someone keys your paint job or smashes your windows. Fire. An engine fire, a garage fire, a wildfire. Flooding. You're parked in a low-lying area during a flash flood. Hail. The golf ball-sized dents. Windshield cracks and chips from a rock flying up on the highway. Falling objects like a tree branch in a windstorm or ice falling off a roof. And critically, hitting an animal. Yes, you read that right. Hitting a deer is not a collision. It is a comprehensive claim. This is one of the most common points of confusion in all of auto insurance. The logic, as strange as it sounds, is that the deer hit you, not the other way around. The event was outside of your direct control in a way that a typical collision with a static object or another vehicle isn't. So, collision is for when you hit a pole. Comprehensive is for when a deer hits you. It's a weird distinction, but it's a critical one for your policy. So, you have these two shields protecting the value of your car. Collision for crashes and comprehensive for life. But how do they actually work when you need to use them? They both operate using something called a deductible. The deductible is probably the most important number you will choose on your entire policy, because it's the amount of money you agree to pay out of your own pocket for a repair before the insurance company pays a single dollar. Think of it as your copay for a car repair. Deductibles typically range from $250 all the way up to $2,000 or more. The most common are $500 and $1,000. Let's make this crystal clear with an example. Say you slide on some black ice and hit a curb, causing $2,000 worth of damage to your wheel, axle, and bumper. This is a collision claim. You have a $500 collision deductible. When you take the car to the shop, you will pay the first $500 of the repair bill yourself. Your insurance company will then pay the remaining $1,500. If the damage was only $400, you wouldn't file a claim at all, because the total repair cost is less than your deductible. It would all be on you. This works the same way for comprehensive. A hailstorm causes $3,000 in damage, and you have a $500 comprehensive deductible. You pay $500. Insurance pays $2,500. It's a simple concept, but the choice you make has a huge impact. There's a trade-off. A lower deductible, like $250, means you pay less out of pocket when something happens, but your monthly premium will be higher. A higher deductible, like $1,000, means your monthly premium will be lower, but you'd better have that $1,000 saved up and ready to go if you get in a wreck. It's a balance between saving money now versus paying more later. Now, a crucial question. Do you legally have to have collision and comprehensive coverage? Unlike liability coverage, which is required by law in nearly every state, the answer is generally no. If you own your car outright, meaning you have the title free and clear with no car loan, you can legally drive with only liability coverage. You can choose to drop collision and comprehensive to save money. But, and this is a massive but, if you have a loan on your car or if you are leasing it, the answer is almost certainly yes, you are required to have them. Your lender, the bank or credit union that gave you the loan, will absolutely require you to maintain both collision and comprehensive coverage with a deductible no higher than a certain amount, usually $1,000. Why? Because until you pay off that loan, they are the true owners of the car. You're just borrowing it. The car is the collateral for their loan, and they are protecting their investment. If you wreck that car and don't have the coverage to fix it, they're out tens of thousands of dollars. So they make it a mandatory condition of the loan. If you drop the coverage, you'll be in violation of your loan agreement, and they can actually buy a policy for you, a very, very expensive one, and force you to pay for it. So, when does it make sense to consider dropping these coverages? It comes down to a simple calculation. The value of your car versus the cost of the coverage and your deductible. Imagine your car is an old beater, worth maybe $2,000. You're paying, say, $400 a year for collision coverage with a $1,000 deductible. If you get in an accident and your car is totaled, the absolute most the insurance company will pay you is $1,000. That's the $2,000 value of the car minus your $1,000 deductible. So you're paying $400 a year for a maximum potential payout of $1,000. At that point, you might decide it's better to self-insure. Save that $400 a year in an emergency fund and accept the risk yourself. But there's one more giant, critical piece of the puzzle you need to understand. It's called actual cash value. When your car is significantly damaged or stolen, the insurance company doesn't pay you what you paid for the car. They don't pay to buy you a brand new one. They pay you the car's actual cash value, or ACV. ACV is what your exact car, with its specific year, make, model, mileage, and condition, was worth in the marketplace the second before the accident happened. This is where so many people face a brutal financial shock. You bought your car 3 years ago for $35,000. Today, you get in a major accident, and the insurance company declares it a total loss. Because of depreciation, your car's actual cash value is now only $19,000. That's the check they're going to write you minus your deductible. They hand you a check for $18,000, and you're left standing there thinking, how am I supposed to buy another $35,000 car with this? You can't. That's not what the insurance is for. It's designed to give you the cash value of what you lost, not replace it with something new. And this creates a terrifying financial trap. You get a check for $18,000. But what if you still owe $22,000 on your car loan? You now have to give that entire check to the bank, and you are still $4,000 in debt for a car that is now a twisted heap of metal in a junkyard. You have no car, and you still have to write a check for $4,000. It's a financial nightmare. And it happens every single day. Fortunately, there's a specific, often inexpensive, type of coverage designed to prevent this exact catastrophe from ruining you. This coverage is your personal financial bodyguard. And it goes by the name Uninsured and Underinsured Motorist Protection. Let's call it UM/UIM for short. This is one of the most misunderstood and, frankly, most important parts of your entire auto insurance policy. Why? Because while liability coverage protects you from the financial consequences of hurting someone else, UM/UIM protects you when someone else hurts you and they can't pay the bill. It's your insurance company stepping in to play the role of the at-fault driver's non-existent or inadequate insurance. It's a safety net for a world where not everyone is as responsible as you are. Think about it. 1 out of every 8 drivers on the road in America right now is uninsured. 1 in 8. Look out your window. Count the next 8 cars that go by. Statistically, one of them has no insurance at all. If that person plows into you and puts you in the hospital, who pays your medical bills? Who covers your lost wages while you recover? Without this specific coverage, the answer is terrifyingly simple: you do. You're left to sue a person who likely has no assets to begin with, which is why they didn't have insurance in the first place. It's a dead end. This is where uninsured motorist coverage, the first half of our dynamic duo, comes in. It's designed for 2 primary scenarios. First, the most obvious one. You're hit by a driver who is confirmed to have 0 insurance. They broke the law, they caused the accident, and now you're injured. Your uninsured motorist bodily injury coverage, or UMBI, will step in to pay for your medical expenses, your physical therapy, and even your lost income up to the limits you selected. The second scenario is even more common and insidious. A hit and run. A driver slams into your car, sending you off the road, and then they speed away, disappearing into traffic. The police can't find them. In the eyes of your insurance company, a phantom driver is an uninsured driver. You have no one to hold accountable. Again, your UMBI coverage swoops in to save the day, covering your injuries as if you'd gotten the other driver's information. It is, quite literally, the only thing standing between you and a financial catastrophe and a hit and run where you are injured. Now let's talk about its partner, underinsured motorist coverage, or UIM. This is the one that would have saved our friend from the last example, the one left with a $4,000 medical bill. Underinsured motorist coverage applies when the at-fault driver does have insurance, but their liability limits are too low to cover the full extent of your damages. And this happens all the time. Millions of drivers only buy the bare minimum coverage required by their state. In some states, that minimum for bodily injury is as low as $15,000 or $25,000 per person. A single night in the emergency room after a serious crash can exceed that. One surgery can blow past it. Let's replay our scenario. You have $30,000 in medical bills. The at-fault driver has a state minimum policy of $25,000. Their insurance pays out their maximum, the full $25,000. That leaves you with a $5,000 deductible from your health insurance, which we agreed you paid, but you're still short that other $4,000. Your health insurance won't cover it because it's supposed to be the car insurer's job. The other driver's insurance can't cover it because they've hit their limit. So you're stuck. But not if you have underinsured motorist coverage. If you had, say, $100,000 of UIM coverage, your own insurance company would step in and pay that remaining $4,000. Instantly. No lawsuit, no collections agencies, no stress. Your UIM coverage filled the gap between what the other guy owed you and what he could actually pay you. It made you whole. So we have uninsured for the drivers with no insurance, and underinsured for the drivers with not enough. Both of them typically come in two flavors: bodily injury and property damage. We've been talking mostly about bodily injury, or UMBI and UIMBI, because your health is your single greatest asset. This is the coverage that protects your body, your ability to earn an income, and your family's financial stability. Then there's the property damage side, UMPD. This is designed to repair or replace your car if it's damaged by an uninsured or hit-and-run driver. Now, this is where things can get a little tricky. If you already have collision coverage on your policy, which we'll discuss in detail next, UMPD can sometimes be redundant. Collision coverage pays to fix your car regardless of who is at fault, even if it's an uninsured driver. However, UMPD often has a much lower deductible than collision. Your collision deductible might be $1,000, while your UMPD deductible might only be $250. So, if an uninsured driver hits you, using UMPD could save you $750 out of pocket. In some states, you can't even buy UMPD if you have collision, so you'll need to check your specific policy. But the key takeaway is that the bodily injury portion of UM/UIM is absolutely non-negotiable. Protects you in a way no other coverage can. Now for the pro tip that can literally double your protection for just a few extra dollars a month. Stacking. The concept sounds complicated, but it's actually very simple. If you have more than one vehicle on your auto insurance policy, some states allow you to stack your uninsured motorist coverage. Let's say you have 2 cars, and you chose $100,000 of UMBI coverage for each car. If you have stacked coverage and you get into a terrible accident, you can combine the limits from both cars. So, you would have $200,000 of coverage available for your medical bills, even though you were only driving one of the cars at the time. It even applies if you're a pedestrian or on a bicycle, and you're struck by an uninsured driver. If you have non-stacked coverage, you only get the limit assigned to the specific car you were in at the time of the accident, in this case $100,000. Stacking is an incredibly powerful and inexpensive way to create a massive financial shield for your family. Not all states offer it, but if yours does, you should ask your agent about it. The difference in premium is often negligible, but the difference in protection is enormous. So, the million-dollar question, how much UM/UIM coverage should you actually have? The answer is simple, and it's a rule of thumb used by the best insurance professionals everywhere. It's called the mirror rule. You should have at least as much uninsured and underinsured motorist coverage as you have bodily injury liability coverage. Go look at your policy right now. If your liability limits are 100/300/50, meaning you have $100,000 of bodily injury liability per person, then you should have $100,000 of uninsured motorist bodily injury per person. Here's the logic, and it's impossible to argue with. If you believe you need $100,000 of liability coverage to protect your own assets in case you seriously injure someone else, why on earth would you accept less than that to protect yourself and your own family from an irresponsible driver who injures you? Are you not worth as much as a stranger? Is your family's financial future less important than someone else's? By mirroring your limits, you are placing the same value on your own well-being as you place on your financial responsibility to others. It's the most logical and responsible decision you can make. And the best part? Because you are the one who is being protected, and insurance companies know that people are generally less likely to commit fraud against their own policy for these claims, UM/UIM coverage is shockingly affordable. We're often talking about a few dollars a month to go from a dangerously low limit to a truly protective one. It is the single best bargain in the entire world of insurance. You are no longer just insuring against your own mistakes. You are now insuring against the mistakes of the 1 in 8 drivers who have no coverage, and the millions more who have nowhere near enough. You're taking control. So now you're protected. If another driver without insurance hurts you, your medical bills are covered. Your lost income is replaced. Your family is secure. But what about your car? It's sitting on the side of the road, a mangled heap of metal and glass. Who pays to fix that? Who pays to get you back on the road? That's where the two most commonly confused coverages in history come into play, and understanding the vital difference between them is the key to not overpaying for coverage you don't need, or worse, not having the coverage you desperately do. Let's talk about collision and comprehensive coverage. They are the twin pillars of protecting your own vehicle, and 99% of the confusion about auto insurance lives right here, in the space between these two words. They sound similar. They're often sold as a pair, and they both pay to repair or replace your car after it's been damaged. But what triggers them is as different as night and day. Let's start with collision. The name says it all. This coverage is for when your car collides with something. Anything. Another car, a telephone pole, a guardrail, a fire hydrant, your own garage door. It even covers you if you flip your car over in an accident. The key element is impact. Your car was moving and it hit an object, or it was hit by another moving car. Imagine this scenario. You're at the grocery store, backing out of a tight parking spot. You're checking your mirrors, you're looking at your backup camera, but you misjudge the distance to that concrete pillar. You hear that sickening low-pitched crunch of metal and plastic. Your heart sinks. You get out, and sure enough, your rear bumper is caved in and your taillight is shattered. It's a classic, frustrating, and entirely your fault accident. This is the exact moment collision coverage becomes your best friend. Without it, that repair bill is 100% on you. With it, you just have to deal with your deductible. A deductible is the amount you agree to pay out of pocket for a repair before your insurance company starts paying. Let's say the total repair cost for your bumper is $2,000, and you have a $500 collision deductible. You pay the body shop the first $500, and your insurance company cuts a check for the remaining $1,500. It's that simple. Your insurance fixes your car after a collision, minus your share of the cost. The higher your deductible, the lower your monthly premium will be, because you're agreeing to take on more of the financial risk yourself. We'll come back to that. So, collision is for crashes. What about everything else? What about all the bad things that can happen to your car when it's just sitting there, minding its own business? That is where comprehensive coverage steps in. In fact, some policies literally call it other than collision coverage, which is a perfect description. Comprehensive protects you from a whole list of perils that have nothing to do with a traffic accident. Think of it as the act of God and act of criminal coverage. A massive hailstorm rolls through and turns your car's hood into a golf ball. That's comprehensive. A deer decides to leap out of the woods and headbutts your front fender on a country road. That's an animal collision, which, believe it or not, falls under comprehensive, not collision. A branch from your neighbor's ancient oak tree snaps off in a windstorm and crushes your roof. Comprehensive. Vandals spray paint your car or slash your tires. Comprehensive. A thief breaks your window and steals your stereo, or worse, steals the entire car. Comprehensive. Fire, floods, earthquakes, riots. It's all covered by comprehensive. The key difference is that in a comprehensive claim, you weren't driving into something. Something happened to your car. Just like collision, it has a deductible. Let's say that tree branch did $5,000 worth of damage. If you have a $1,000 comprehensive deductible, you pay the first $1,000, your insurance covers the next $4,000. Many people choose to have a lower deductible for comprehensive than for collision, because the events are often completely outside of their control, but the principle is identical. So let's put it all together. You hit a pole? Collision. A pole falls on your car? Comprehensive. You rear-end someone? Your liability pays for their car, and your collision pays for your car. A thief steals your car? Comprehensive pays to replace it. This brings us to the most important question you need to ask yourself. Do I actually need both? For liability, the answer is always yes. It's the law. But for collision and comprehensive, the answer is, it depends. It depends almost entirely on the value of your car versus the cost of the coverage. Insurance is a financial tool. It's meant to protect you from catastrophic financial loss, not from minor inconveniences. If you're driving a 20-year-old sedan that's worth maybe $1,500 on a good day, does it make sense to pay $400 a year for collision coverage that has a $1,000 deductible? Absolutely not. You're paying for a benefit you can almost never use. First, you'd have to pay the first $1,000 of any repair yourself. Second, if the damage is bad enough to cost more than the car is worth, say $2,000, the insurance company will just total it and write you a check for its actual cash value, which is only $1,500. After you subtract your $1,000 deductible, you get a check for a measly $500. You paid $400 for the privilege of getting $500 back after a major accident. It's a terrible deal. A good rule of thumb is this. When the annual cost of your collision and comprehensive coverage is more than 10% of your car's value, it's time to seriously consider dropping it. You can look up your car's private party value on a site like Kelley Blue Book. If your car is worth $3,000 and your coverage costs more than $300 a year, you're probably better off banking that money in a personal car repair fund instead. But, and this is a massive but, there is one situation where you have no choice in the matter. If you have a loan on your car or if you are leasing it, you are not the true owner. The bank or the finance company is, and they have a vested interest in making sure their asset, their car, is protected from every possible angle. For this reason, virtually every lender in the United States will require you to carry both collision and comprehensive coverage, often with a maximum deductible of $1,000. It's not optional. It's a condition of your loan. The moment you fail to provide proof of that coverage, they can either buy a policy for you at an insanely high price and tack it onto your loan payment, or in some cases even repossess the vehicle. The day you make that final car payment and the bank mails you the title is a day of freedom. Not just because you're debt-free, but because now, and only now, do you get to make the decision for yourself. You can look at your car's value, look at the cost of your coverage, and decide if keeping full coverage is a smart financial move, or if it's time to scale back to just liability. So to recap, collision is for crashes, comprehensive is for chaos, and whether you need them depends on if you're protecting your asset or the bank's. But there are still gaps. What if the person who hits you has no insurance at all? What if their cheap state minimum policy isn't enough to cover your brand new SUV or your medical bills? You did nothing wrong, yet you could be left holding a massive life-altering bill. That's where our next two coverages come in, and they might be the most important and most affordable protection you can buy. These two coverages are called uninsured and underinsured motorist protection. And I'm not exaggerating when I say they can be the only thing standing between you and absolute financial catastrophe. Let's break that down because the names sound confusing, but the concept is brilliantly simple. Think about liability coverage, which we talked about earlier. That's you paying to protect other people from the damage you might cause. Uninsured and underinsured motorist coverage is the exact opposite. It's you paying to protect yourself from them. It's your own insurance company stepping in to play the role of the at-fault driver's insurance when they either don't have any or don't have enough. Let's start with uninsured motorist, or UM. This one is straightforward. You're driving perfectly, following all the rules, and someone with zero insurance plows into you. They are clearly at fault. Normally, their bodily injury liability would pay for your hospital bills, and their property damage liability would pay to fix your car. But they have nothing. Zero. You can sue them, sure, but you can't get blood from a stone. If they can't afford a $40 a month insurance premium, they definitely can't afford your $80,000 medical bill and your total $30,000 car. This is where uninsured motorist coverage saves you. Your own insurance company steps up and pays for your injuries, and depending on your policy, your car repairs up to the limits you selected. You are protected from the irresponsibility of others. Now let's talk about its sneaky cousin, underinsured motorist, or UIM. This situation is far more common and far more dangerous because it gives you a false sense of security. Let's go back to that accident. Someone runs a red light and T-bones your car. This time they're not totally irresponsible. They have insurance. The problem is they only bought the bare minimum required by the state to be legally on the road. Let's say their state minimum for bodily injury liability is only $25,000 per person. But your injuries are severe. You have a shattered leg, you need surgery, physical therapy, and you're out of work for 4 months. Your total medical bills and lost wages come to $150,000. The at-fault driver's insurance company will write you a check for their policy limit, $25,000. And that's it. They've fulfilled their legal obligation. They are done with you. So, who pays the remaining $125,000? Without underinsured motorist coverage, that person is you. Your life has been turned upside down by someone else's mistake, and now you're facing a 6-figure bill that could force you into bankruptcy. But if you have underinsured motorist coverage, your own insurance policy kicks in to cover the difference, paying that remaining $125,000 up to your policy limit. It takes a potentially life-ruining event and makes you whole again. That's the power of this coverage. Now, these two are almost always sold together, often listed on your policy as UM/UIM. And just like liability, they are split into two main parts: bodily injury and property damage. Uninsured/underinsured motorist bodily injury, or UMBI, is the part that covers you and your passengers for medical expenses, lost wages, and even pain and suffering. This is the big one. This is the coverage that prevents a car accident from destroying your financial future. When you select your limits, you'll see numbers like 100/300. That means your policy will pay up to $100,000 for any single person's injuries, and up to a total of $300,000 for everyone injured in your car combined. My advice, and the advice of nearly every financial expert, is to set your UMBI limits to be at least as high as your own bodily injury liability limits. If you think you're capable of causing $100,000 in damage to someone else, you have to assume someone else is capable of causing that much damage to you. Now here's a pro tip that your insurance agent might not even explain properly. Look for the term stacking. In many states, you can choose to have a stacked UM/UIM policy. What does this mean? It means if you have multiple cars on your policy, you can combine the UM/UIM limits from each car to use on a single claim. Let's say you have 2 cars and each has 100/300 in UMBI coverage. If you get into a bad accident in one of those cars, a non-stacked policy gives you access to that car's 100/300 limit. But with a stacked policy, you can literally stack the coverages on top of each other, giving you a total of 200/600 in protection. It costs a little more, but it's an incredibly powerful way to multiply your coverage for a relatively small increase in your premium. If stacking is available in your state, it is almost always worth it. Next, there's uninsured motorist property damage, or UMPD. This covers repairs to your car if it's damaged by an uninsured driver. Now you might be thinking, wait, doesn't collision coverage already do that? And you're right, it does. So why would you need UMPD? 2 reasons. First, the deductible for UMPD is often much lower than for collision. You might see a UMPD deductible of just $250, while your collision deductible is $1,000. That's $750 back in your pocket. Second, in some states, using your UMPD won't be considered an at-fault accident on your record, which could prevent your rates from going up at renewal, whereas a collision claim sometimes can, even if you weren't at fault. It's a layer of specific, cheaper protection. However, be aware that in many states, you can't use both for the same claim. UMPD is there to fix your car, and if you don't have it, you then use your collision coverage as a backup. So why is all of this so critically important? Because the number of uninsured drivers on the road is terrifyingly high. The national average is about 1 in every 8 drivers. That's more than 12% of the cars you see on your daily commute having no insurance at all. And in some states, it's much worse. In Mississippi, it's 1 in 4. Florida, 1 in 5. New Mexico, 1 in 5. This isn't a rare 1 in a million event. It's a common everyday risk. Every time you get behind the wheel, you are rolling the dice, betting that one of those tens of millions of uninsured or underinsured drivers won't make a mistake that changes your life forever. And now for the best part. After hearing all this, you're probably thinking this life-saving coverage must be incredibly expensive. It's not. In fact, UM/UIM coverage is often one of the most affordable parts of your entire auto policy. You can often get hundreds of thousands of dollars in protection for just a few extra dollars a month. Why is it so cheap? Because when your insurance company pays out on a UM/UIM claim, they don't just forget about it. They gain the legal right to go after the at-fault driver to get that money back. This is called subrogation. Now, they may not be successful. Remember, you can't get blood from a stone, but the possibility that they can recover some of their costs allows them to charge you a much lower premium for the risk. It is, without a doubt, the single best bargain in the entire world of insurance. So I want you to do something right now. Pause this video, pull up your own insurance policy on your phone or computer, and look for uninsured motorist, or UM/UIM. Check your limits. If you don't have it, call your agent today and add it. If your limits are low, like the state minimum 25/50ths, raise them to match your liability coverage. It will be the smartest money you ever spend. It is the armor that protects you and your family not from your own mistakes, but from the potentially devastating mistakes of others. So now your body and your car are protected from the irresponsible drivers out there. But what about the little things? The everyday hassles that can cost you hundreds of dollars out of pocket? What about a flat tire on a dark highway? Or locking your keys in the car at the grocery store? Are you covered? Most people think they are, but they're often wrong. The next 2 coverages we'll talk about are the unsung heroes of your policy, and one of them might already be costing you money somewhere else without you even realizing it. Let's start with the big one. the coverage that protects you from the 30 million plus drivers in America who are breaking the law every single day. I'm talking about uninsured and underinsured motorist coverage. This isn't just an add-on. It's your personal financial bodyguard. Imagine this scenario. You're driving home from work, you have a green light, and you proceed through the intersection. Out of nowhere, a car runs the red light and T-bones you. It's a bad one. Your car is totaled, and you're rushed to the hospital with serious injuries. The police report clearly states the other driver was 100% at fault. So, their insurance should pay for everything, right? Your medical bills, your lost wages from being unable to work, your physical therapy, your pain and suffering, and the value of your destroyed car. But then you get the call. The other driver has no insurance. They were driving illegally. Suddenly, that other driver's problem has become your nightmare. Who pays for the mountain of bills now piling up on your kitchen table? Without uninsured motorist coverage, the answer is terrifyingly simple. You do. It all comes out of your pocket. All of it. Uninsured motorist coverage, or UM, steps in and acts like the insurance the other driver should have had. It covers your bodily injuries, your hospital bills, your lost income, your recovery costs, up to the limits you select. In some states, there's also a separate uninsured motorist property damage coverage that will pay to repair or replace your car. It essentially saves you from financial ruin because someone else was irresponsible. Now there's a second part to this. Underinsured motorist coverage, or UIM. This is just as important. Let's go back to that same accident. But this time the at-fault driver does have insurance. The problem is, they only have the bare minimum required by the state. Let's say their policy limit for bodily injury is $25,000 per person. That sounds like a lot of money until you see the first hospital bill. An ambulance ride, an emergency room visit, a few x-rays, and an overnight stay can blow past $25,000 before you're even discharged. What if you need surgery? What if you're out of work for 6 months? That $25,000 is a drop in the bucket. Once their insurance pays out that maximum of $25,000, they wash their hands of it. They're done. But your bills are at $150,000 and climbing. This is where underinsured motorist coverage becomes your hero. If you have a UIM limit of, say, $250,000, your own policy can step in and cover the difference, in this case the remaining $125,000 of your bills. It fills the gap between what the at-fault driver's cheap policy covers and what you actually need to recover. Here's the single most important piece of advice I can give you about these coverages. Look at your own liability limits, the amount of coverage you have in case you hurt someone else. Now look at your uninsured and underinsured motorist limits. Are they the same? If not, you need to ask yourself why. Why would you be willing to provide more financial protection for a complete stranger you might accidentally injure than you are for yourself and your own family? Your UM and UIM limits should, at a minimum, match your own liability limits. It is the most logical and cost-effective way to protect your own life and livelihood. Now, for the second unsung hero, the one that might be costing you money right now. Actually, it's a pair of coverages: rental reimbursement and roadside assistance. These seem small, but they are giants of convenience. Let's start with roadside assistance, sometimes called towing and labor. It's exactly what it sounds like. If you get a flat tire, run out of gas, lock your keys in the car, or your battery dies, you make a call and someone comes to help. If you need a tow, it's covered up to a certain distance. It's usually incredibly cheap to add to your policy, maybe $1 or $2 a month. So, where's the hidden cost I mentioned? Pull out your wallet. Do you have a AAA card? Or a similar auto club membership? If you do, you are very likely paying for the exact same service twice. You're paying your insurance company for roadside assistance, and you're paying a separate company $100 a year or more for the same thing. Many premium credit cards even offer this as a free perk. So my challenge to you is this: check your auto policy. Check your credit card benefits. Compare them to your auto club membership. See which one offers the best service. Maybe one offers 100 miles of towing versus 15 miles, and cancel the ones you don't need. It's an instant way to save money. Next up is its partner, rental reimbursement. If your car is damaged in a covered accident, it could be in the shop for weeks. How do you get to work? How do you take your kids to school? You have to rent a car. And with rental prices today, that can easily be $40, $50, even $60 a day. A 3-week repair could cost you over $1,000 out of pocket, just for a temporary car. Rental reimbursement coverage pays for that rental car for you. It's usually sold with a daily limit and a total limit, for example. $40 per day up to a maximum of $1,200. This means it will pay up to $40 each day for a rental, for a total of 30 days. For the price of a single cup of coffee per month, you can save yourself a massive financial headache. A quick pro tip: call a local rental agency and see what their daily rate is for a basic car. If it's $50 a day, and your coverage is only for $30, you should increase it. It costs almost nothing to bump it up. Finally, let's talk about the cousin of health insurance: medical payments coverage, or MedPay. In some states, it's a more robust version called Personal Injury Protection, or PIP. This coverage is simple. If you or your passengers are injured in a car accident, it pays for your medical bills up to a set limit, regardless of who was at fault. The first thing everyone asks is, wait, I have health insurance. Isn't this redundant? The answer is a resounding no, and here's why. First, MedPay has no deductible and no copay. If you have a $5,000 health insurance deductible, you have to pay that $5,000 out of your own pocket before your health insurance pays a dime. But if you have $5,000 in MedPay coverage, it can pay that deductible for you. It's a financial shock absorber. Second, it's immediate. It pays the doctors and hospitals right away, without the delays and arguments that can sometimes happen with health insurance companies trying to determine if a treatment was accident-related. Third, and this is huge, it covers your passengers. What if you get in a minor fender bender and your friend who is riding with you needs to go to the emergency room to get checked out? Are you going to ask them for their insurance information? Is it going to be awkward if they have a high deductible or no insurance at all? MedPay handles it. It pays for their medical bills, no questions asked, which can preserve your friendship and prevent a potential lawsuit. It's goodwill in the form of insurance. Whether it's MedPay or PIP, having even a small amount like $5,000 or $10,000 creates a critical buffer that protects your savings, your passengers, and your peace of mind after a crash. It fills in all the annoying gaps that health insurance leaves behind. These coverages, uninsured motorist, rental, roadside, and MedPay, are the ones people try to skip to save a few bucks. But as we've seen, declining them is like building a house with no roof. You might save some money up front, but you're completely exposed when the storm eventually hits. So now you know the coverages. You understand what they do. You've built the perfect policy, your ironclad fortress of financial protection. But what happens when you actually have to use it? What's the one phrase you should never say to an insurance adjuster after an accident? What are the critical steps you must take in the first 24 hours to ensure you get paid every single penny you're owed? Getting into an accident is the test. Filing the claim is where you pass or fail. In the next part, I'll give you the official playbook. The clock starts the second you hear the crunch of metal. In that chaotic moment, your brain is flooded with adrenaline, and your first instincts are almost always wrong. This isn't just a fender bender. It's the start of a financial chess match, and the moves you make in the next 60 minutes can determine whether you get a check for the full value of your damages or a denial letter that costs you thousands. First, before you even think about your phone, before you look at the damage, take a deep breath and do a safety check. Are you okay? Are your passengers okay? If your car is in a dangerous spot like the middle of a highway and it's safe to move, get it to the shoulder. Turn on your hazard lights. Your life is worth more than any car. Once you've established that everyone is out of immediate danger, the playbook officially opens. And page 1 of that playbook has 3 giant words written in red. Do not apologize. Never ever say, I'm sorry. In the real world, I'm sorry is a polite thing to say. In the world of insurance claims, it is a recorded admission of fault. It doesn't matter if you think you might have been partially to blame. It doesn't matter if it just slips out. That one phrase can be used by the other driver's insurance company to deny your entire claim. Just don't say it. Along those same lines, when the other driver asks if you're okay, your answer is not, I'm fine. Your answer is, I'm not sure yet, I need to get checked out. Adrenaline is a powerful painkiller. You could have a serious neck or back injury and not feel a thing for hours or even days. If you say, I'm fine at the scene, and a witness or police officer hears you, the insurance company will use that statement against you when you later file a claim for your medical bills. You are not a doctor. Do not diagnose yourself at the scene of an accident. With those critical don'ts out of the way, let's move to the do's. Your first phone call is not to your spouse, not to your boss, and not to your insurance company. It's to 911. Even for a minor accident, you might think it's overkill, but you need a police report. A police report is an objective, third-party account of the incident. It contains the other driver's information, their insurance details, witness statements, and often, the officer's initial assessment of fault. Without a police report, a claim can devolve into a he said, she said nightmare, and insurance companies love he said, she said because it gives them an excuse to pay nobody. Calling the police is non-negotiable. It is the foundation of your entire claim. While you're waiting for the police to arrive, your smartphone becomes the most important tool you own. You are now a crime scene investigator, and you need to document everything. Don't just take one picture of the dent on your door. That's useless. You need to tell a story with your photos. Start wide. Take pictures of the entire accident scene from multiple angles. Capture the position of the cars, the street signs, the traffic lights, and the weather conditions. Is the sun in a position where it could have blinded a driver? Is the road wet? These details matter. Then move closer. Take photos of all four sides of both vehicles, not just the damaged areas. This prevents the other driver from later claiming pre-existing damage was caused by you. Now get forensic. Take close-up, detailed photos of the actual damage on both cars. Get down low, get up high. Capture paint transfer, broken parts, everything. Take a photo of the other car's license plate. And here's a pro tip. Take a clear picture of their VIN number, that little metal plate you can see through the bottom of their windshield. It's another layer of undeniable identification. While you're at it, look around. Are there skid marks on the road? Is there debris? Document it. You are building a mountain of visual evidence that an insurance adjuster cannot argue with. Next, you become a journalist. Are there any witnesses? People standing on the sidewalk, other drivers who stopped? Witnesses are pure gold. A neutral third party who saw what happened is the most powerful weapon in your arsenal. Politely approach them and say, "Excuse me, did you happen to see the accident?" If they say yes, ask for their name and phone number. Don't ask them to write a statement. Just get their contact info. Your insurance company will do the rest. Most people are willing to help, but they won't stick around for long, so you have to act fast. When the police arrive, be calm and stick to the facts. Don't guess, don't speculate, don't embellish. I was traveling north in the right lane at approximately 30 miles per hour. The light was green. The other vehicle entered the intersection and struck my passenger side. Factual. Simple. Undeniable. Give the officer your license, registration, and insurance card. Cooperate fully. Get the officer's name, badge number, and the police report number before you leave the scene. You'll also need to exchange information directly with the other driver. The law requires you to exchange your name, address, phone number, and insurance information. Use your phone to take a picture of their driver's license and their insurance card. It's faster and more accurate than writing it down. If the other driver is being evasive, if they don't want to provide their information, or if they say, "Let's just handle this without insurance," that is a massive red flag. Do not agree. Wait for the police. This is often a sign they are uninsured or have something to hide. Okay, you've handled the scene like a pro. You're safe, the police have come and gone, and you have a phone full of evidence. Now, you make the second call to your insurance company. Most companies have a 24/7 claims hotline or an app. Use it immediately. The longer you wait, the more it looks like your claim isn't serious. When you make this first call, you are only doing one thing: reporting the basic facts of the accident. You will give them the date, time, and location. You will provide the other driver's information and the police report number. That's it. The person on the other end of the line may try to get you to give a recorded statement right then and there. Your answer should be, "I'd be happy to provide a statement, but I need to do it at a later time. I'm still a bit shaken up." This is critical. You are not refusing to cooperate. You are simply taking a moment to collect your thoughts before you make a statement that will be scrutinized word for word. You want to give that statement when you are calm, prepared, and have your facts in order. Finally, within the first 24 hours, you must go see a doctor. Go to an urgent care clinic or your primary care physician, even if you feel perfectly fine. Remember what I said about adrenaline. It masks injuries. You might wake up tomorrow with debilitating whiplash or back pain. Going to a doctor creates a medical record that officially links any potential injuries to the accident. If you wait a week to see a doctor, the other driver's insurance will argue that your injury could have happened somewhere else. By not seeing a doctor right away, you could be forfeiting your right to have thousands of dollars in medical bills paid for. You've now flawlessly executed the 24-hour playbook. You've protected yourself legally, medically, and financially. You've gathered an ironclad case file of evidence. But all of this was just the preparation for the main event. because soon your phone is going to ring. On the other end will be an insurance adjuster from the other driver's company. They will sound incredibly friendly, concerned, and helpful. They are none of those things. They are a highly trained negotiator whose sole job is to minimize the amount of money their company has to pay you. They have a script, they have tactics, and they know all the weak spots to press. But now you have a playbook. And in the final part of this series, I'm going to give you the counterscript. I'm going to show you exactly what to say and what not to say to turn their own tactics against them and ensure you walk away with the maximum settlement you are rightfully owed. The phone rings. You see an unfamiliar number, but you know who it is. The insurance adjuster. Your heart rate picks up a little. This is the moment. This is the conversation that can define the next few months or even years of your financial life. But you are not going to be a victim. You are going to be a strategist. You are prepared. The adjuster is friendly, disarmingly so. They'll ask how you are, express sympathy. Their voice is calm, professional. Their goal is simple: to close this claim as quickly and as cheaply as possible. Your goal is also simple: to be made whole. To be compensated fairly for every single loss you've incurred because of this accident. These two goals are in direct opposition. This is not a conversation. It is a negotiation from the very first word. They will almost immediately ask for a recorded statement. They'll say it's just for our records, or standard procedure to get your side of the story. This is the first and most critical test. You fail this test and you've given them a weapon to use against you for the entire process. A recorded statement can only hurt you. You might be on medication. You might be in shock. You might misremember a tiny, insignificant detail that they will later frame as a lie to discredit your entire claim. You do not say no. That sounds confrontational. You use the phrase that gives you complete control. When they ask for a recorded statement, you say calmly and firmly, "I'm not prepared to provide a recorded statement at this time. All the relevant information is in the police report. I will be in touch when I have all my facts and documentation in order." That's it. You are not refusing. You are postponing. You are signaling that you are taking this seriously and won't be rushed. Next comes the second landmine, often disguised as a simple pleasantry. "So, how are you feeling today?" It feels rude not to just say, "I'm fine, thanks." But those words can be typed into a file and used to argue that your injuries weren't that serious. On day 2 post-accident, the claimant stated they were fine. You must never ever say you are fine. You also shouldn't invent a list of dramatic injuries. You stick to the facts and remain non-committal. The correct response is, "I'm following my doctor's treatment plan. The full extent of my injuries is still being evaluated." This is 100% truthful. It's professional, and it gives them nothing. It tells them that the value of your injury claim is not going to be determined by a casual phone call, but by medical professionals. Within a few days, especially if the car is a total loss, you might get the third and most tempting trap, the quick settlement seduction. The adjuster will call with an offer. They'll have a check ready to overnight to you for, say, $2,000 or $3,000, plus they'll pay for your initial medical bills. Sounds so good. You have bills piling up, you need a new car, and this feels like a fast, easy solution. This is a calculated tactic. They are preying on your financial stress. They are dangling a small amount of money in front of you now to save them from paying a much, much larger amount later, after you realize you need 6 months of physical therapy or that your back will never be the same. Your counterscript is crucial here. You say, "I appreciate you putting together an offer so quickly, but it's premature to discuss a final settlement. I haven't completed my medical treatment, and the full scope of my damages, including potential future medical needs and lost wages, is not yet known. I will present a comprehensive demand once I have that information." You have just transformed their lowball tactic into an opportunity to set expectations. You've told them professionally that you will be the one to initiate settlement talks, and you will do it from a position of power with full documentation. From this point forward, you control the flow of information. After that initial call, you send a follow-up email. This is non-negotiable. You write, "Thank you for the conversation today. To ensure we both have a clear and accurate record of our communications, please direct all future correspondence to me via this email address. I will do the same." You have now created a paper trail. No more he said, she said. Everything is in writing. This makes adjusters far more careful with what they say, and it gives you an undeniable record of everything that has been offered, stated, or requested. Now, you focus on building your case. You go to every doctor's appointment. You track your mileage to and from the pharmacy and physical therapy. You get a letter from your employer documenting every hour of work you missed. You save every receipt, every bill, every explanation of benefits. You are no longer just the patient. You are the CEO of your own recovery and your own claim. When you have reached what doctors call maximum medical improvement, meaning you're as good as you're going to get, it's time to go on offense. You will do this with a document called a demand letter. This is your ultimate weapon. It is a professional, organized letter that you send to the adjuster that lays out your entire case. It doesn't have to be full of fancy legal words. It has to be full of facts. It should have 5 simple parts. First, a brief statement of facts: who, what, where, when, why. State clearly why their insured driver was at fault, referencing the police report. Second, a detailed summary of your injuries. Describe the diagnosis, the treatment you received, and how the injuries have impacted your daily life. The constant pain in my lower back prevents me from lifting my child or sitting at my desk for more than an hour. Third, a categorized list of all your special damages. These are the hard numbers. List every single medical bill line by line with a grand total. List your lost wages with documentation from your employer. List any other out-of-pocket expense. Fourth, you discuss your general damages. This is for your pain and suffering. You can't put a receipt on this, but it is a very real loss. Explain your physical pain, your emotional distress, your anxiety. Finally, the 5th part, your demand. This is the total number you are demanding to settle the claim. A common starting point is to take your total medical bills and lost wages and multiply it by 3 to 5, depending on the severity and permanence of your injuries. This is your opening offer. You email this letter with all your documentation, every bill, report, and letter, as a single PDF attachment. And then you wait. The adjuster will respond. They will almost never accept your first demand. They will come back with a counteroffer, and it will be insultingly low. They'll say your doctor overcharged, that you didn't need that much physical therapy, that your pain and suffering claim is too high. Do not get emotional. Do not get angry. This is the game. You respond to their points not with emotion, but with more evidence. My treatment was prescribed as necessary by my orthopedic surgeon, whose report you have. Your offer does not adequately compensate for the fact that my doctor has stated, I will likely need ongoing care for this chronic condition. You go back and forth, justifying your position with your documentation. Each time you communicate, you are calm, professional, and firm. If you reach a complete stalemate, where they refuse to budge from an unreasonable number, you have one final card to play. You don't threaten. You don't yell. You simply state a new fact. You say, it seems we're unable to agree on a fair value for my claim based on the extensive documentation I've provided. At this point, I'm going to need to consult with an attorney to understand what my options are for moving forward. The word attorney changes the entire dynamic. The adjuster's job is to avoid litigation. It's expensive and time-consuming. Signaling that you are prepared to take that step is often the single most powerful move you can make to get them to come back to the table with a serious, fair offer. Through this entire process, you have taken back control. You've turned their playbook against them. You've gone from being someone an accident happened to being the person who is directing the outcome. This knowledge, this strategy, is the most valuable coverage you can ever have. It's the one thing that no policy limit can define and no adjuster can take away from you. Over these 10 parts, we've pulled back the curtain on an industry that thrives on complexity and confusion. You now understand your policy, you understand the tactics, and you understand your power. You know more than 99% of the people on the road next to you. You're not just a driver anymore. You are an informed consumer, a prepared advocate, and the one person who will always fight for your own best interest. Drive safe, but more importantly, drive smart.